Okay, welcome everyone. We'll start our third lesson. Lesson 3 is about our learning outcome 3, be able to prepare the budget and report on variance. So today lesson is the budget and budgetary control. And in this lesson, we'll discuss about LO3, which is a learning outcome 3. So during this lesson, we'll cover all assessment criteria, and I included all the activities as well. I'll go through a bit, recap what we learned before starting our lesson. First, we'll recap what we learned during our last lessons. So let's please. I'm going to share this with you specific window. So during our first lesson, we discuss about understand the financing option. We discuss about the sources of finance, internal, external. We discuss about the equity financing, debt financing. So what is the difference between, we said debt is cheaper than equity. Then we said there need to be look around the gearing ratio. If the debt is more, that can be also is a risky as well. So we need to be make sure we measure those things very effectively. Then second, we discuss about in second learning outcome in second lesson, understand how the organization manage cash flow. We discuss about the cash flow. We discuss about internal and external cash flows. We discuss about the sources of cash flows. We discuss, the receipt and the payment, inventory turnover days. Those we discuss in lesson 2. In lesson 2, there were quite big, there were good five were the assessment criteria, one for merit and two for distinctions for the where we learn about and we prepare the cash budget as well. And we discuss about credit and credit control, credit policies, how we can measure the credit, and I included a lot of examples in our slides as well. So please go through if you have any questions still. And we said working capital is a running capital, which is basically the current asset minus current liability. Current asset means the asset which we can use within a year, current liability which we have to pay within a year's time as well. So that's called current. So that's short term as well. Today lesson is focused on the be able to prepare the budget report and on variance. So we have a quite big lesson in a way. So that's why I included a lot of example. I'll go through abstract of each. So identify the factor influence forecasting. What is the forecast? Always any budget you prepare, first thing is the sale forecast. If you're expecting this, let's say example of the coronavirus, due to the coronavirus sale forecast is dropped, our economics growth forecast is dropped. Ultimately, what will be happen on the budget? Your budget need to be adjust accordingly. So you're expecting less cash will be inflow, maybe more cash outflow. We need to make the budget where the cash will come. Second, we look at the budget from given forecast data. So we'll prepare the budget. Master budget means the major budget, overall budget of organization that can affect all of that budget. So calculate the actual variance. So we'll discuss about different types of variance. I included some example, and I'll upload extra document to do practice on the variance if you really keen about the learn variance, which is quite good to be learned to be in the management perspective as well. So because our subject title is the budgetary control. Evaluate the useful of budgetary control. Yes, budgetary control is very important. That will help and is quite value in the organization if we have a right budgetary control in place, because we have unlimited wants, we have limited resources, and we have to apply them effectively. Then we discuss the behavior of the budget. It can be fixed and flex, and then analyze the cost. So cost behavior, it can be fixed, flex, and variable. Then evaluate the factor that can influence the budgetary control. That's all will be focused today lesson. So we'll move and we'll start our lesson. Anybody any questions? So please, if you have any question, if you're listening this recording, please drop me email. So you can rate yourself before starting your this lesson. What do you know about budget? What do you know about budgetary control? And how much you know about variance? So what is meant by variance to you? So all in the previous lesson, your knowledge as well, you can link, so you can rate yourself where you all up to overall knowledge in this unit and regarding this topic. So we'll move. So we'll go through now. First is identify the factor that the organization forecast the data and produce. The factors then can influence. So what do you think? So just think about what those are the factors those influence. So think about budget. You make your home budget. What factor? Inflation is a key factor because due to the inflation, cost will be increased. So new legislations. So we can look around the new legislation that also affect because you need PPEs, personal protection equipment. So that's you need it. You need to buy it. If you don't fulfill, it costs you. So of course it will disturb your budget. GDP. What is the GDP? Gross domestic product. It's called national income. So if your national income drops, per capita income, per capita income, it means per person income drop, then of course, so all the budget will be disturbed. So we need to look around internal source of information that can be financial record, purchase invoices, wage information, sale information, inventory record. These also impact on your future forecast. External sources, we need to look around the government statistics, trade information, financial newspaper, and all these information. Then we discuss some micro environmental factor we need to be look around. Those can impact. So further, I added the slides. If you want to read, the underneath, all there. So you can move up this and you can read it. Yes, what is meant by these in detail. So we can look around what's come under political factor. You need to look around political stability, tax policies, like Donald Trump produced in America, corporation tax, that can be huge impact on the businesses. Employment laws, if it's a tough legislation on employment, company need to be, it will be incur more cost. Economic factor, inflation rate, exchange rate, think about again the pound against dollar against various other currencies. So we need to look around, we need to make a plan that all budget, the factor will affect, social trend, people behavior towards buying goods, technology, think about the technological change and by people shopping online nowadays. Then we need to look around further factors, sale forecasting, method of forecasting, we can look around sale forecasting technique, knowledge about the sale expert, business, ask the customer, do research, and use the pestle or the pest analysis. Look around the product life cycle. Have four stages: introductory, growth, maturity, decline. So think about in the G phone, Apple first G phone, and then think about iPhone 10, iPhone 11 now. So it's a different life cycle. These are all their products, and that also impact your budget. The cash budget or the manufacturing budget, because the first budget you need to prepare always you need to be look around the sale forecast. Any budget, whatever you make, it's always based on the sale forecast. Okay, next we need to do research. So research can be, you maybe look around the random sampling techniques and the quota sample you pick, the 10% sample, that also help, to make the budget, because that also, if you have a good information, good research, then you can make the right budget. Then we have a different techniques, which is time series, which is also known as the moving averages. So moving averages, you may learn time series analysis, a method of calculating the trend. What is the trend now? People are shopping online more. Is the trend is growing due to the coronavirus? Seasonal variation. Think about in December during Christmas. Think about other religious festival. That's the seasonal variation as well. Different season and different festival and summer, winter, and all, the sales impact. So then we have um, time series analysis method, which we can use. You look around, if t is equal to this, t represent the time, and you look around, and f is the supply, and what is we are forecasting. So we can use this formula, t equal to y minus s, and then we can calculate it, what is the forecast and what is the seasonal trend. So it's quite crucial to be look around forecasting using trend and seasonal variation. So this is model, we can use it, and that's quite, that also be the forecasting model. Other forecasting model further, we can look around these being proportion and multiple models. So we can look around, now we can look around income and the spending and the savings. So what is the relationship between them? Okay, then further we can look around index. Indexes, you maybe heard about the price index, consumer price index. In the UK we call CPI, consumer price index. CPI, consumer price index. So you need to look around what is the price index is going. Like recent budget in India and a different part of the world, like even in Pakistan, they forecast, the inflation will be 6.5% in the next year, or it used to be 9% inflation. And in some part of, think about Venezuela, is 15% inflation, 20% inflation. So what is happening? Retail, the impact, that's a forecast, when we do and make budget. So these are the techniques we need to look around. Okay, this is the indexing. We can look around forecasting techniques. So we always look these. Further, we can look around high and low method, which is we calculating fixed and variable costs, forecasting your expenditures for future. Then we have a second 3.2. In 3.2, prepare the organization budget. We have to prepare the budget. I gave the example here. I mentioned you earlier. Sale budget. Sale budget is will be the come first. Then you can make the production budget. Then you can make the material usage and the labor utilization, material purchase budget based on these budgets. So always good to be please look around what come first. So first always is the budget is called sale budget. Okay. Then we can look around further. Next slide is about, like I mentioned, the budget and the relationship between. So overall, this is the master budget. So master budget is represent all other budgets. So capital expenditure budget is a sort of master budget because where you major expense most of the money. So country UK budget is a master budget, then the councils and the local authorities budget is called sub budgets, and the local budget are we call operational budget. Okay, so then when we make the budget, so you need to look around any budget you make, you need to look around the waste and rejection and inefficiencies. So all these need to be adjusted. So different standard we can ideal standard, which is the ideal situation. So but now is a coronavirus and uncertainty. You need to keep in mind. So think about your rejections, how many percent product reject. You need to make it. So always this is also example of the budget. So you think suppose 2% gross production is rejected. So you need to make sure you make it 102%, 2% more than 100 to make it, because 2% will be rejected. You need to look around the rejected product, what price. So I added some example here. So please, it's good to go and embed in your writing. If you have any question, you can drop me email. I can further explain you. Okay, then incorporating the waste into, so we've been looking always budget is sale, then closing inventory, you add minus opening inventories, and then you embed, rejections in your budget. Okay, so other factor we can look around overhead. Overhead is being not directly impacted the cost indirectly. So those are overhead. So we need to be controlled. Those can be fixed, those can be variable, and always we need to embed in our forecasting and when we prepare our budget. Thanks. So next now we're looking 3.3. In 3.3 the master budget. So when producing a master budget manually, the major problem is ensuring that the initial entry in the budget or any adjustment to be budget item is dealt with the every budget is the relevant to the master budget. So in the effect, budgets need to be comply with the normal double entry bookkeeping to be consistency if you based on your double entry bookkeeping. Suppose for instance that the sale in the last month were expected to rise 10,000. So what adjustment would be necessary? So you need to be look around sales credit, and you need to look around debit. So is expected to rise. So you can say your receivable or your cash flow will be rise accordingly as well. Using the spreadsheet, all above adjustment we can automatically can be adjusted if we apply the right formula. So Excel spreadsheet is quite crucial. So when first thing sale budget, if the customer take more than 1 month to pay, then of course you look around the cost would increase, the purchase would need to be increased, we need to look around payables need to be increased, we need to look around the inventories we need to be managed, and budget can be, and the profit can be increased as well ultimately. So we included the example of one of example is a cash budget. So you look around this all where the money will come, how much money will goes. So we've been given all the like first 50% debtors our customer pay in first month, 50% in pay the later month. So we can make the cash budget. So I prepared on the next slide this budget for you, so you can look around. So we have an opening balance, Now how much is the receipt we are expecting in those months we need to, and what we are expecting the payment. So difference between the receipt and payment. So we'll see here these November and December we have a less cash, and we have to be make some arrangement where the money will come from and our budget. And that budget can be, because if we don't have a cash, ultimately what will be happen, we will be out of the business, so we need to be managed. So this is part of also be the budget, so we can make it the sales, because if you're selling today, it's not mean you're receiving cash. It's looking and preparing in the master budget the cash point of view as well, which is quite crucial to be looked around. Anybody any question? Then we have a 3.4 where we need to look around and we have to prepare and some control mechanism. So always control is mean the measuring the actual budgetary performance against the actual performance. So we're looking here, we preparing our budget based on 90-100% capacity. So 100 was the 50,000 units, so times by 1.05, so that give you 105. So that's my 90, which is 90% of 50,000 time by the selling price. That's the based on 90%, that's 100%, that's 105. So always when we compare our budget, so look around the actual budget which is based on 3,500 units. So you need to be reduce it accordingly, because the material, labor are variable cost, production overhead can be fixed cost, admin can be fixed cost as well if we are paying the salaries according to the fixed rate, because salary is a fixed and the wages are the variable. Anybody any question? Okay, then in the budgetary control you will see there by flex budget, which is flex is according to 37,500 units which actually we are producing and selling, and then actual cost what. So we look the different, there is a variance there. So adverse variance, my sales revenue is less than, so you will see there is a decrease, adverse, 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 and we have only admin is a favorable, and overall we have adverse variance. So we need to be identify why is adverse. Is it the decision? So if we produce and sell 35,500, our variance will be adverse. So if we produce more and sell more, our variance can be converted into the favorable, because the unit per unit cost will be reduced and we can look around. So when you limiting to flexing, always split mixed cost is not always easy. So fixed maybe behave step in fashion and look around those all the cost behavior, fixed cost variable. And the budgetary control is mean the control which we need to be placed, and the control help to make the right decision for the future. So if you have a plan, there is a no control. It's like you with respect of the smoker, every year make the smoking, they make the target to be quit the smoke, but after few months or few weeks, they start smoking again in the same order, may be higher than the previous year. So we need to think about what control. Maybe we need to engage ourselves in different activity, maybe take nicotine. So some control need to be in place to be achieved. So set the target, enable to the organization to monitor its performance. So when we want to be monitor the performance is always based on three things, guys. Always look performance is equal to performance. So look performance. If you want to be measure somebody's performance, always look in cost, in quality, and in time. Because if you're looking reduce time, the worker will takes time quicker and will use less material. But think about the quality. If the quality will drop, ultimately what will be happen? So ultimately it will be happen. So we need to be make sure we focus on the three areas. Yes. So then we a couple of you maybe heard our 3 E's concept. So you need to look around effectiveness, you need to look around the KPI, whatever your KPI industry benchmark, you will be your performance of the worker need to be up to that level. If you have next level, you more than the industry, maybe your 95% customer is satisfied, in the industry was only 90% customer satisfied, so you very economical. So but still you have a cost high. If you're in all areas you exceeding, like per unit cost is your less, like in China per unit cost is maybe because they're producing in trillion. Maybe the worker is well trained and they have upskilling properly, so they're using the less time. They have automated technology, or other part of the world as well. So that efficiency is equal to the cost and the time. But time, and then we need to look around if the quality will improve as well, then it says a very efficient in all areas, so that come under efficiency. Yeah. Okay, so we discuss about quality, what quality measures we can take it. If you have any questions, so you can, so please. And then wastage of material, we need to think about how we can reduce it. What, efficiency and productivity, we need to think about that also. Bring and capacity, yeah, relevant to both labor and machinery. Take refer to the labor hours, machine hours, and appropriate activity level depends, and all this we need to be look around effectively. That will also help. And next we looking 3.6, we need to look around and evaluate the usefulness of the budget and the budgetary control. So budgetary control is very useful, is a comprehensive system of budgeting to add the management to carrying out and the function like planning, coordination, and control. The system involved dividing the organization into the functional area, preparing separate budget, consultation, comparing with actual, and finding the variance. So that's all. Then the budget classification of budget according to time, according to function, according to flexibility. That's, and we can use for a control. Fixed budget stay the same, and the flex will change with the level of output. If you don't flex it like NHS budget, if you don't pay according to the user, if the number will increase, your budget need to be increased. Otherwise, the waiting time 4 hours or the target, whatever, if we can't achieve it. Simple way. So cost behavior can be fixed. Variable cost, the cost which stay the same, is a fixed cost which change with the unit of production is called variable, and the semi-variable like line phone line rental is a fixed, and the call charges is variable, that's called semi-variable. So there are some example of fixed and variable, and then fixed budget and the flex budget is some example there how we can compare. And absorption cost is mean full cost, where fixed and variable cost is absorbed to into production. And these are the further example how we can make the flex budget. Okay, then next we looking 3.1M is analyze the behavior. Behavior is mean where we looking the fixed cost. Like earlier we said, fixed cost will stay the same. Variable cost, the cost will change. Semi variable is mean fixed FC plus VC, which is variable cost, and always total cost is equal to TC. Total cost always equal to FC fixed cost plus variable cost. If you know the total and you need to look around how much is a fixed and variable, we can use the method is called high-low method. So that's been it's been explained in this slide, and you can look around and we analyze how much is a fixed and variable being analyzed in this example. Then we have a 3.M2, which is analyze how the cost behavior knowledge link with the forecasting. Of course, unit cost when you calculate material, labor, and overhead. So cost behavior is depends. So we need to look around what is the prime cost. If the prime is all direct cost, that directly. Direct cost is the cost which we can trace within the product. The traceable cost is called direct cost. What is the direct cost? The cost which you can trace within a product, direct labor, direct material, how much worth of, So cost behavior we mentioned in this slide as well. Variable cost, which is also known as marginal cost, is all variable. Fixed cost, the cost stays semi-variable, is a fixed, and step cost is mean like a step, like a ladders, Your cost will be fixed. Like think about if we can live two people in a room, so that's the fixed cost. Even you living one or two, the same cost will be as a rent. So if we need to live three people, we can't really fix in a one room. So what we need to do, we need to hire one more room. So we will be moving to step next, So that can be step costs. And you will see there the example of fixed, variable, and step cost. So it's good to be, and we can use high-low method to differentiate how much fixed, how much is variable. That's all been product cost, overall product, period cost, and the cost behavior. That's we discuss in 3D. So next we're looking 3D. If you want to work toward the retention, we need to look around what sort of the factor influence. So there's sale budget. These are the budget we can make, and all these, can be due to the various factors we discuss in our um, 3 3.1 as well, which is political, economic, social, and technological. Further, we can look around if you want to further in details. We can look around it. Can the concept called Porter 5 forces. Uh, so those, we can look around the customer power, bargaining power, supplier power, and the rivalry in the industry. How much is the competition? I added to address this. I added few example here. So please, good to be read these case studies and go through. That's the is crucial. That will help to we achieve our organization objective effectively. So I included the quiz for you as well. You can copy and paste this link and do, and it shows you at the end you're right and wrong, where you went. You can review it, and that's all today lesson. If you have any question, please drop me email on my email address anjum@ukversity.uk. I'll get back to you as soon as possible. And thanks for listening, and thanks for attending. So I hope speak you during next lesson, which will be about the how we can prepare our assignment. I'll give you general guidance and where we can find the relevant resources, how we can write, how we can structure, how we can address these learning outcomes within our assignment. If you have any question in the meanwhile, feel free to drop me email. Thanks for listening. Have a nice time. Thank you. Bye bye.